We got inflation data this morning, and this moved interest rates. You may be wanting to incorporate an investment portfolio strategy that takes advantage of movements within interest rates. One of the ways to do that is to use exchange traded funds or ETFs. There are two ETFs that come to mind that you could use, and these are the bigger ones. One is TLT ETF, which follows the price of bonds. Now, this morning's inflation numbers pushed interest rates up. There's an inverse relationship to interest rates and price. This brought the price of Treasury bonds lower. So in that case, TLT ETF actually fell. If you thought that we would continue to get bigger inflation data points pushing interest rates higher, pushing the bond markets lower with the inverse relationship, you may want to trade a inverse ETF that would do the opposite of the Treasury market. In the case of the inflation data that we got this morning, bond prices fell, interest rates went up. TBT ETF did the opposite. It spiked up in price as an ETF, an exchange traded fund, because interest rates moved higher. You may be looking for an investment portfolio strategy to incorporate to take advantage of the inflationary pressures that we're probably going to be seeing, considering where we are with inflation, generally speaking, with a hot job market, the fact that we're getting tariffs, which would be inflationary, and the fact that the federal government is likely to pass legislation for taxes that are going to increase the deficit as well. Those three things are inflationary. Prices for, or interest rates would move higher, so TBT ETF would move higher. On a short-term basis, this could be a strong investment portfolio strategy. But eventually, the Federal Reserve will get inflation under control. Then you may want to consider TLT ETF, which means you would take advantage of interest rates moving lower, price moving up for TLT ETF.